First of all, there's the top line data that's out there, which does show growth of the virus in China is plateauing, or at least appears to be, while it continues to spread in other countries. But inside China, economists are looking at alternative data showing that the country is not getting back to work as quickly as hoped. For example, traffic congestion in Beijing running 20% to 60% below 2019 averages. Less congestion is a sign that economic activity is running below normal. Similarly, coal consumption, not even close to where it usually is. It's a very big deal in a country that gets 60% of its power from coal. You can see how far that is below normal there. All of this leaning against the hopes that China would get back to work by the end of this month. J.P. Morgan this morning slashing its growth forecast for the first quarter in China, and now looks for the economy to contract 4%, and that compares with a previous forecast of 1% growth. It sees a stronger bounce back now in the second quarter, up 15%. Compared to a 9% rebound. Writing in a commentary, J.P. Morgan says the pace of factory reopening has been slower than we had anticipated. The fundamental issue is the policy dilemma between virus control and normalization of economic activity. A prolonged slump, of course, could mean the knock-on effect to the U.S. could be worse, at least in the first quarter. So far, Fed officials have not changed their stance on waiting for more evidence of a U.S. effect before committing to rate cuts. It's not the view of the market. They've got a 59% chance of an April cut, 53% chance of a second cut in July, and they're toying with a third cut with a 46% probability for December. A second quarter bounce back in China, that would validate the Fed's stance here, but the Chinese data so far have yet to back up the forecast that the country is coming back to work, Sarah.